Good morning, everyone. Welcome to this update for the 10th of April for global stocks. The title this week is it's all about gold. And as you know, if you've been following these weekly videos for some time, that I'd been pretty cautious on gold until we saw some more positive signs. But in the last couple of weeks, we've certainly seen those signs come through very, very clearly. So I'm now far more comfortable about what's going on, and I actually feel really quite quite excited and comfortable with the way things are unfolding, because there certainly is some very, very positive signs, and the market, there's a degree of predictability to what we're seeing. The market really is behaving a lot dictated by technical patterns, and they're somewhat more predictable than fundamentals, because fundamentals are a lot about perception, and we can't ever feel really confident that we understand the perception that the masses are really taking, whereas technical patterns tend to be more clear cut. We know what the ground rules are. And so I'm just finding markets a little bit easier to get your head around, not so much in the short term, but certainly over the medium to longer term. Now, it's probably no coincidence that gold and particularly gold stocks are now making a fairly positive move, because in the last 3 months or so, I've really developed some serious concerns about what central banks are doing to the financial system. And therefore, by definition, to all of our financial well-being. This is not getting a lot of airplay, but it's starting to become more of a topic of discussion now. They've just gone off in a series of desperate moves to, hold the system up where, against the normal process of economic cycles. They're trying to rewrite the laws of economics, and I just think it's going to play out very, very badly. Now, I'm not going to back myself into a corner by making some big headlines, because there's plenty of people out there that are going to do that. They've done it over the years, and they've been consistently wrong. If you've been watching me for a while now, you'll know that my approach is basically to look at what the market is doing and respond, not to make big grandiose statements about the future just so that you can grab a headline and make a name for yourself. I just think that's a pointless exercise. So that's not what I'm doing here. I have some serious concerns, and I think they're increasingly being shared by a lot of people, that negative interest rate policy and a tripling of debt since 2009 by central banks is just cloud cuckoo land, and that it has to end very badly, and it's going to be the average investor that's going to end up paying the price. So those two things have kind of come into really great clarity for me. My concerns about the financial system in total, I don't know how it's going to play out, and I don't know when it's going to play out badly. I just feel now very, very confident that there is going to be a very, very bad ending. Now, I've been saying that for some years, but I was also quick to add that it could be 5 years or 10 years away. I feel that what central banks have done in the last month or 6 weeks, particularly in Europe and Japan and in America, has brought that day of reckoning forward considerably, and it could all unfold and unravel very, very quickly from here. Anyway, look, enough of those sort of comments. Let's have a look at what actually transpired last week. So this is really just putting a bit more substance to what I've just been saying. That the central bank policy is absolutely flawed in my view, and the same for a lot of people. Negative interest rates is really just trying to destroy the law of economics. And as with any bank, the financial system, any bank, if confidence fails, then people all rush to get their money out, and you get what's called a run on the banks. So the banking system exists purely on confidence because it's so leveraged. And I think that the financial system over the last couple of decades is held together because central banks have had the confidence of the people. But they've now pushed policy so far into insane territory that, and they've increasingly gone to more and more desperate measures, and they've contradicted themselves and backtracked and all those sort of things that I think they're just losing the confidence of a lot of people, and therefore when confidence goes with the amount of leverage and debt in the system, that's what really bothers me. So looking at the actual markets for the week, the S&P was down by 26 points. It's still overbought, and what's been coming through clear to me is that there's a lack of demand at these upper levels. There's if you look on a daily basis or even on an intraday basis, the volumes have really tailed away, and there's really a lack of demand for buying. Now, having said that, there's not necessarily a big increase in supply of stocks for sale either. So we seem to be in this, this kind of twilight zone where the market's just hanging there. And if you step back a little bit more broadly, the market in the US, I'm talking the S&P 500 here, has been range bound since March of 2014. So that's 2 years between roughly 1,800 points and the peak at around 2130. And that's a heck of a long time for a market to have been in limbo. And I'm pretty convinced that the only reason that it has been in limbo and hasn't rolled over into more of a correction that you would normally expect after, a 5-year bull run, is central bank policy, and all the stimulation and all the liquidity has gone into boosting asset prices. If it wasn't for that, which I think is unsustainable, then we would have had some sort of more significant correction, 20, 25, 30% correction. It would have been well and truly done and over and finished, and we could get back to life as normal. But because central banks just seem hell bent on trying to hold things up, that's why markets have stayed where they are. Now, earnings season in America starts this week, kicks off with Alcoa, and I believe that will play a large part in how the market resolves, whether it resolves to the upside or whether it resolves to the downside. I would encourage you to really keep an open mind about which way the market would go. So coming back to my earlier comments, you shouldn't be approaching the market with a view that you think this is going to happen or that's going to happen. Let's just see what does happen and then have a game plan to go with that. It's the only way to play these markets. So keep an open mind, but look, the Federal Reserve is doing its best to keep markets levitated at the level that they're at, or to push them up higher. And those guys have got enormous firepower. So that's why I don't have a particularly strong opinion about whether the market's likely to go up or down. So let's take a look at the S&P. So we'll start first of all on the daily chart, and you can see last week down a little bit, and it does seem to be running out of gas, and certainly the volumes have been tailing off. Now, yes, we got above the 200-day moving average, which is the red line. And yes, we did break this declining trend line that picked up the peaks from the 4th of November last year and also the 1st of December. So there certainly are some positives, but it's really struggling to get up higher. And I think if earnings season is not particularly good, then I reckon we're a reasonable chance of getting back down here to this level down here, which is around about the 1950 mark, and that may present then a better opportunity. Just panning back a little bit more broadly, just to show you what I was talking about from 2014. So there's the dive in October, but you can really go back to March, really. Come all the way back to here where that vertical line is. So that's March of 2014, and you can see that it's just been one huge big rounding top, and central banks have really prevented that from rolling over to the downside. Whether it ultimately does that or not, time will tell. But certainly the market is struggling at this level. That's for sure. So just look at it on a monthly chart, gives you a little bit better view. So clearly the character of the market has changed. The very, very powerful uptrend from 2009 has now morphed into something different. We've now got a big sideways pattern. And look, all things considered, if you asked me which of the alternatives, which is a bear market, a bull market, or a sideways market, is going to be in play for the next 6 to 12 months, I would have to go for the sideways market for a whole bunch of reasons. So I think that's that's a distinct possibility. Turning now to Australian stocks, the Aussie dollar got up to over 77, backed off to 75.5 to finish the week. And the ASX 200 index was down by yet another 63 points. So we remain in pretty significant downtrend. The lack of liquidity is causing some large volatility in individual stocks. We've seen really good safe stocks in the food sector, in the healthcare sector, sold down by 25, 30, 35% when there's absolutely no announcement and no reason for the price to go down. There's just a whole lot of irrational selling that is being amplified by the fact that there's just not a lot of liquidity at the moment. I think a lot of people are very nervous about the market. So the downtrend continues in the ASX 200. And also, too, you may have noticed or you may have read that Commonwealth Bank is really on the brink. We'll take a look at that chart. Personally, I think the chart technically looks negative and looks like it's about to break down. However, when I look at it fundamentally, the fact that there's a very, very substantial yield on offer, something like about 8.5%, then it defies logic that the price would break down. But one of the things that has really become screamingly evident to me over the last 6 to 9 months is that you should place far more emphasis on technical considerations and technical patterns than you do on fundamentals, on valuations, or on logic. So who knows? Let's have a look at the Aussie market. So we'll start with the ASX 200. And if we pan back, you can see there's a very, very clear trend channel. We had a little bit of a look over it in the middle of March, but well and truly back within that trading range. And, you're looking at 4,500 in the near term is distinctly possible. If this goes back to the bottom of the trading range, then that's about the level that you're looking at. Now, just turning to CBA. So you can see here we've got what looks to be quite a large head and shoulders pattern. Here's the left shoulder here, here's the head, here's the right shoulder. And we've now revisited this support level 3 times. If this doesn't hold, then generally support level will break on the 3rd test or on the 4th test. So unless we get a fairly solid rebound out of here, then I think CBA is in trouble. And again, on technical grounds, I'd be targeting around about $55, which basically takes the distance from the head down to the neckline, and you add that again, gets you down to about 55. However, the logic of the dividend at that level just seems crazy. So I don't know how this is going to resolve, but I'd certainly be a bit cautious about what level of exposure you have to Australian banks, because the market is basically pricing CBA and the other major banks as though they're going to cut their dividends. So just something to be aware of. Now, turning to commodities, gold was $16 higher for the week. What's impressive about gold is that it's been so resilient in the face of an extreme rally in general stocks. The rally in the S&P 500 has been extremely strong, and yet gold, and that should really be gold's normally a fair trade, so it would normally go in the opposite direction to the general market. But gold's just had its best quarter in 30 years. Now, yes, the market went down initially at the start of January, but then there's been a very, very powerful rebound as well. So whichever way you look at it, gold has certainly put in a terrific performance. There's also been a massive 33% surge in the holdings in GLD, which is the world's largest gold ETF. That hit a low in January of around 650 tons, and since then it's really come back very, very hard, and it's up around the 860, 870 tons, and it's a similar surge to what we saw from February 2009, and that then panned out into a very, very substantial rally in gold and an enormous rally in gold shares. So if it follows the same pattern, then we've got some very attractive opportunities ahead of us. There's no question in my mind, and I'm following a lot of key data, particularly with the amount of money that's flowing into GLD. You can get that data on a daily basis. So there's no question in my mind that a lot of the world's biggest players are diversifying their portfolios by going into gold. There's no other explanation for the huge lift in investment demand, not when the holdings of gold in GLD had halved from 2012 to the end of 2015. The other thing that really encourages me is that gold stocks are outperforming very, very significantly, especially in America. And gold stocks almost always lead in advancing gold itself. When we look at GDX and GDXJ in just a minute, you'll see just how powerfully they have moved, and they've far outperformed gold, and that's a really positive sign for gold. So let's take a look at the gold market. So we'll start first of all with gold on a daily basis. Let's take a bit of a pan back, and we've broken out of this downtrending channel, but when you look at it, we've really failed to retrace very far. It's retraced back to the blue 50-day moving average line, but it hasn't even been able to get back to what I would consider to be a minimum retracement, a 38.2% retracement, and also back to this previous peak here in October. That you'd expect that to normally happen. Hasn't. Gold's continued to hang up there quite well, and gold stocks have done enormously well. So the signs are getting more and more encouraging that we're not going to see a retracement, and that the whole sector is just going to push on from here. Let's look at a weekly chart. Gives you just a slightly cleaner view of what's going on. So we've had the initial surge. We haven't had a retracement. All we've had is a consolidation, which is a very positive move. Now let's just look at GDX index. So GDX, it's still within this overall big downtrend. However, compared to the previous occasions where it moved up in 2014 and again in 2014 and again here in 2015, every time that happened, the price of GDX failed to form a new high. This time it has. We've clearly formed a new high. We've clearly gone above the 200-day moving average, the red line, and we've stayed up there for a lengthy period of time. And again, there's just been no retracement. I would have thought this was at least a minimum level to come back to, around just under $18, and probably more likely to come back to around $17. It didn't ever happen, and you can see a very, very strong move on Friday night. And I'm tracking around about 40 gold stocks in America, and I'm tracking around 20, 25 gold stocks in Australia. So that gives me a very good picture on an individual stock basis of what's going on. And this is sector wide. This is a really, really substantial move. Let's look at GDXJ, even more impressive, and it broke out above this important resistance level on Friday night. So lots of positives about gold, that's for sure. Copper was down to $2.12. Base metals are back under pressure again, which is interesting considering the US dollar has not gone up. So it's not a healthy sign. Crude oil got down to 35, but rebounded very, very powerfully on Friday night, got back to almost 40. But the hopes for a production freeze, which I think is the only hope, if the Saudis and other Middle Eastern countries and Russia agree to some sort of production freeze, then there might be some chance that crude oil could regather to 50 odd dollars. But that hasn't happened. And the hopes of it happening are fading fast, I believe. So therefore, I really can't see crude oil being able to go too far. Now, I've put up this chart because it just shows you that the green line is the S&P 500 index, the black line is the price of oil, and you can see the extraordinary level of correlation between the two up until just a couple of weeks ago. And now we've seen the price of oil drop significantly and stock values not drop accordingly. So after an incredible period of correlation, which really was outside the norm, we're now looking like we're starting to return to something normal, which is there isn't a particularly strong correlation between oil and stocks. That's the way that it normally is. So the period you're looking at there where there was this amazing correlation is really the exception, not the rule. There's the chart for spot copper. So declined off the highs. So just to wrap it up, I think a US correction is the greater possibility, but I'm not talking about a bear market. I'm just talking about a correction of the excess. It's overbought. So I'd really encourage you to trade what you see. Don't get an idea in your mind that you're either bullish or bearish and then look for those opportunities because you're likely to get yourself in hot water doing that. Just be capable of trading or investing in both directions and just let the market show you the way. Be patient. You might have to wait weeks or even months. But if you are patient, then you can pick up the opportunities and you can make a really, really good return in very, very short periods of time. You don't have to be invested across the whole year. You can be very selective about that. Now, gold stocks really are the big story. It's really about the only thing that's really moving and showing signs of continuing that move. So the signs are very, very positive. This is not a time for complacency, though. And any turmoil that we get in the market, and I'll be absolutely staggered if we don't get at least another burst or two of significant stock volatility this year, it's an opportunity to make money, and you need to see it that way. Don't be scared, don't be put off by it. It's a great opportunity as long as you're prepared and you're very clear in your thinking about what you're doing. I'd encourage you to keep a very balanced view of the positives and the negatives. Stay unemotional about what's unfolding. I think there's going to be significant disruptions, I believe, over the next couple of years. The press will go absolutely nuts over it. But through all that, you've got to try and stay as unemotional as you can about what's unfolding. Just keep an open mind and look for those opportunities. See the market for what it is. Again, trade what you see in front of you, not what you think should be there. And it's easy to say, but it's not such an easy thing to do. And look, it's where I place a lot of my emphasis with members in helping them to get clarity about their thinking, clarity about their plans, and then supporting them through the process of execution. Yes, I give out recommendations like lots of other people do, but you can go anywhere to get recommendations and stock tips, quite frankly. That's the more minor part of the equation. The key is clarity of thought, being prepared, and and having a sounding board that you can talk to when you need it. So I'm just trying to give you the facts through these videos, and I'm also going to be ramping up some further coverage in intra week as well, rather than just weekends, because as I said at the start, I'm really getting quite concerned about where central banks are taking us. I'm as good as convinced it's going to end badly, and I think it's going to require a lot more. A lot more focus from everybody to keep yourself on the right path. So my objective is to give you the information as I see it so that you can make better decisions. So hopefully that's been a helpful video this week for anyone that's not a member that wants to get in touch with me, who maybe is just starting to share my concerns about what's unfolding. There's my contact details. Always happy to talk to you. That's it for this week. Cheers.